Hello, and welcome to Module 8, where we're talking about usury preemption. You might have noticed that we're sort of jumping to the end of the book, going out of order, but I think that it's most helpful to talk about the two types of preemption kind of back to backs. And this version of the book has moved usury preemption to the back. So that's why we're here. As you hopefully recall, in the last module, we talked about Barnett Bank preemption that applies to National Bank, which sets up the principle that federal law will override a state law that prevents or significantly interferes with the exercise by the National Bank of its powers, its bank powers. And so this module, we're talking about a bit more focused type of preemption that just deals with usury. So I'd like to talk briefly about usury to give some context. And usury in the book is in the consumer section, although it really can apply to any type of lending. It doesn't have to be consumer, but there's been a lot of change in consumer lending. And it's brought about by a number of factors, which is why we have more case and more law and more rules. And one is deregulation, which means that historically states regulated interest rates greater than they do now. And to keep in mind, interest rates, except for those in the military, are regulated at the state level. It's not a federal concern. So that's also part of this usury issue that maybe complicates it. So over time, and in part because of this usury preemption that we're going to talk about, states have moved toward removing your usury caps, which are their interest rate caps. Traditionally, all states have them, and some of them either don't have them at all, or more often have removed them for certain types of credit products. Also, the increase in general purpose credit cards. It used to be that only those with the best credit could get a credit card. It was really something quite special. And now they're fairly easy to get. Of course, some are secured, some have higher rates, but most people can obtain a credit card. And that is really because of the next three items. One is credit scoring that started really in the late 80s, which is a very quick way to judge an individual's likelihood of repayment. Now, there can be a lot of debates about whether they're accurate or not, but in general, the credit score is a quick way of saying the likelihood of someone to repay based on their past history of repaying. Of course, you might think right away, well, those who don't have a past history are put at a disadvantage, and that is true. And that can be an area of concern. And for that reason, a lot of lenders and banks are coming up with other ways to look. But credit scoring has really changed the accessibility of credit for most people. Risk-based pricing is another reason. Risk-based pricing means that if people have different credit scores, a bank will charge them different rates of interest. So if you have a good credit score, you will get credit at a lower interest rate. If you have a weaker credit score, but still decent, you'll get credit, but you'll have to pay more. It used to be that just, I don't know, mechanics wise, a bank could really only offer one or two interest rates. But because of computers and technology, a bank can very quickly figure out your credit score and offer you a rate that they think is appropriate for your credit score and offer the next person a different rate. So the ability to charge different consumers different rates has really increased the accessibility of credit. And probably as important as the others is this concept of securitization. And it started in the mortgage industry quite a while ago, but it's the idea where you take the loans, the bank takes all the loans that it makes, and a loan is basically a contractual agreement where you have advanced someone money and they've agreed to pay you back more than you advanced them. And you take all those rights to repayment and you bundle them together and you sell them to investors. And if you think about that, if a bank makes, I don't know, $100,000 loans, they're out all that money and they have all these contracts with people who are going to pay them back. But if they take all those contracts and they sell them, for $100,000 or whatever, then they immediately have more money that they can turn around and lend out. And then they can take all those contracts, they can sell them off, get more money and lend them out. And so that has really increased the ability of banks to lend credit. And they've been doing that in mortgages for a very long time, but they now do it with car loans and credit card receivables. And so it's really changed kind of the ability of banks and other lenders to make a lot of loans. And there's a big market for it. And they're valued based on basically the credit scores and the credit characteristics of the contracts. So to give you a sense of a state usury law, so we know what we're talking about, here's Ohio's general usury law. And basically what it says is that you can enter into an agreement for someone to pay money, and you cannot charge them more than 8%. That's the general law, the general rule. And that's kind of common. 6 to 16% is kind of what most state usury rates are. But this law, as most of them do, then has exceptions, such as for business loans or loans over $100,000. So that's why it's sometimes considered a consumer issue, although there are many states where it's not just for consumers that the usury rate applies. Now, as we talked about previously, Ohio law also says if you're a bank making a loan, you can charge 25%. So it certainly gives you a good idea that banks are definitely given a lot more authority as far as what they can charge. So our first case is really very old, and it gets right to this idea of the competition between state and national banks. We have a Missouri state bank that is limited to charging 8%. And under Missouri law, non-bank lenders can charge 10%. So there's a national bank in Missouri charging 9%. And so this is then challenged by Tiffany, who's actually a trustee in bankruptcy. But anyway, the challenge is that the national bank is not permitted to charge 9%. And something to know is that although a national bank is federally chartered, every bank that's federally chartered still has a home state. So this bank still was a Missouri chartered national bank. So they still have chartering documents, they still have a home state. And as we see, that will have a lot of impact on the rates and fees, because as I mentioned, federal law does not regulate rates and fees. So the national bank has to look to its home state laws. And this is set forth in the National Bank Act, Section 85, which says that a bank can basically charge interest, and it then gives you 3 options as a bank, a national bank. But it's the rate allowed by the state, territory, district where the bank is located, that's its home state, a rate of 1% in excess of the discount rate on 90-day commercial paper, not usually used because that's usually a pretty low rate, or the third one, which is kind of the subject of this case, where it says, unless or except where the laws of a state allow a different rate for state banks, the rate so allowed. And so the question is whether number 3 controls when there is a state bank rate. And here the state bank rate is lower than the general rate, which is quite unusual. But it's how this case came to be. Are these 3 options that a national bank can choose the best of the 3? Or does the third one apply anytime there is a special rate for the state bank? Well, as we've seen before, national banks are national favorites. And so it was very easy for the U.S. Supreme Court to determine that what those 3 options were just that, 3 options. The bank gets to pick the best rate under those 3. And it's called the most favored lender doctrine, because in fact, what the court said was basically they can charge the best rate in their state, be it a bank rate, a licensed lender rate, a usury rate, whatever is the best rate in the state that a national bank has chosen to be chartered in, that's the rate the bank can charge. And so we now have a regulation, because the laws tend to be convoluted, where it basically just lays it out, that a national bank located in a state may charge the maximum rate permitted to any state chartered or licensed lending institute by the laws of the state. if it permits the state law different types of interest on different kinds of loans, the national bank may make those loans under the best rate, subject only to provisions that are material to the determination of the permitted interest rate. And so basically what that means is, for example, in Ohio, there is a 28% rate permitted on loans of less than $1,000. It's for a licensed lender, but a national bank would be permitted to do that also, but only on loans of less than $1,000. So you now know that a national bank can pick the best rate in its home state and charge that. So that was all pretty well and good for quite some time until we get to the 1970s, when banks are becoming a little bit more adventuresome. And here we have two competing banks. One is the First National Bank of Omaha, which is a Nebraska bank, and the other is Marquette National Bank of Minneapolis, which is a Minnesota bank. One of the interesting things you might notice is that this case explains a credit card, because at this time, credit cards were very rare. People didn't really know what they were, so it's explained. And then it's explained the two options. The Nebraska law, where the First National Bank of Omaha is chartered, allows 18% up to the first $900, or basically $1,000, and then 12. And I'm going to tell you that in 1978, probably no one charged over $1,000. So essentially, it's a 18% interest rate on the credit card. Minnesota only allowed 12% plus a $15 annual fee. Now that may come out very similar in the long run, but people don't like to pay a $15 fee up front. And so Nebraska was sending letters into Minnesota saying, get our credit card, no annual fee, and 18% interest, but people are less sensitive typically to the 18% interest as opposed to having to pay $15. Again, it was 1978. So the Minnesota bank says, well, that's not fair. If you're making loans to Minnesota residents, you should be bound to this 12% too. It's not fair for you to cross state lines and, as they say, systematically solicit our potential borrowers. And so the question is, what does Section 85 mean when it says the interest at the rate allowed by the law of the state where the bank is located? And the question is, what was the intent of Congress? And there was also a fairness. Is it fair for that Nebraska bank to be able to lend at 18% to the Minnesota residents when the Minnesota bank can't do that? So it lays out the facts. And so you see the bank is chartered in Nebraska. It has no offices or branches. That's what we call a bank office in Minnesota. It does mail these ads to Minnesota residents systematically. And the card is honored in Minnesota. But the finance charges, the statements are all coming from Nebraska, and the payments are mailed to Nebraska. The cards are mailed from Nebraska, and the applications are approved in Nebraska. So if you were the judge looking at this, what do you think you would think is the answer based on the federal law? I think it's a pretty easy decision. The court said the location of the bank for purposes of the National Bank Act is the location in its organizational certificate, even if it is soliciting out-of-state residents. And those credit cards can be used with out-of-state merchants. And we know that today, you don't have a different interest rate when you cross state lines. It would be very confusing. And this is referred to as the exportation document, in that you get to pick your most favorable rate in your home state, and then you get to export it in your loans to people in any state in the country. And this may give you a sense of why we've had so much deregulation, because you want banks to come to your state so that they can export your positive rate. Now, the Minnesota bank had another argument, and that says if you say this, that the state can use its home state laws when it's making loans in Minnesota, that will really impair the ability of a state to enact usury laws and to protect its citizens. And so the question is, under this interpretation of the National Bank Act, what entity is a state's usury laws protecting? Well, as the Minnesota Bank said, it is really only restricting its own state banks. And in fact, a state really cannot prevent out-of-state banks from coming into its state and making loans at rates that are higher than its own state banks are allowed to charge. And so this is the law that we have today, that because of the Tiffany case, a national bank can pick the best rate in its home state. And because of the Marquette case, it can charge that rate all across the country. And so this should give you a really good sense of why using a national bank is really preferred in these multi-state lending programs, and what a benefit it is to be a bank. Now, obviously, it does require, kind of understanding your home state laws. And as we'll see in the next module, there is still a question. When we say you can export, you can take the best rate and take it into other states, what do we mean by interest? And so that would be, in part, the subject of our next module. Now that we know that national banks have this very, very important and favorable usury preemption, as a practical matter, how does it really work? So that is something to look forward to, and feel free to reach out with any questions.